The most hyped IPO of the decade is already selling off, and half the people watching it have no idea if that means danger or opportunity. Here's the uncomfortable truth. Post-IPO sell-offs in blockbuster names follow a mechanical pattern that has almost nothing to do with the company's actual business quality. The question you need to answer right now is not whether SpaceX is a great company. It almost certainly is. The question is whether great company and great stock entry point are the same thing. And the answer, especially in the 72 hours after a record IPO, is almost never yes. Let us be precise about what is actually happening with SpaceX pre-market. According to CNBC, the stock is falling, continuing a sell-off after its rally and blockbuster IPO. That sentence contains the entire story if you know how to read it. The word continuing is doing a lot of work there. This is not a sudden reversal. This is a process. And it is one that has repeated itself across virtually every megacap IPO in modern market history. Here is the structural reason this happens, and it is not sentiment. When a company goes public at scale, there are multiple categories of shareholders who were sitting on locked up or restricted positions the moment the stock began trading. Early employees, pre-IPO venture investors, certain institutional allocations depending on lockup structure. The IPO itself creates a price discovery event, which means it also creates the first real exit opportunity for people who have been holding paper wealth for years. The rally immediately following a blockbuster IPO is often driven by retail enthusiasm and momentum buyers who see a famous name and a rising chart. That rally, and this is critical, provides the exact liquidity that earlier holders need to begin reducing their exposure. They are not selling because they think the company is worthless. They are selling because the rally gave them a price they could not have gotten any other way 3 months ago. What you are watching pre-market is not panic. It is distribution. And from an analytical standpoint, distribution following a euphoric first-day rally is not only predictable, it is nearly mandatory. The actionable insight here: when a high-profile IPO sells off after its initial pop, the relevant question is not whether to panic, but at what price level does the distribution likely exhaust itself? That is a technical question, not a fundamental one. Now here is where it gets strategically interesting, because SpaceX selling off pre-market is not the only major headline this morning. Bloomberg is reporting that Getty Images soared 200% in early trading after announcing a deal with OpenAI. 200% in early trading. That is not a typo, and it is not a fluke. It is a signal worth decoding carefully. First, let us acknowledge what we do not know. We do not have the specific terms of the Getty OpenAI deal from these headlines alone. What we do know is the market's immediate interpretation that a licensing and data partnership between a major visual content library and the world's most prominent AI company is worth doubling the equity value of that content company overnight. That tells you something precise about where institutional pricing power currently sits. AI companies need training data. High-quality, legally defensible licensed training data is becoming a structurally scarce input. Getty's entire moat, its archive, its licensing infrastructure, its legal track record, suddenly reprices when the largest AI buyer in the world decides that defensible data sourcing matters. This is not about Getty Images as a legacy media company. This is about Getty as an infrastructure play in the AI supply chain. Now connect this back to SpaceX. Both stories are live simultaneously. One stock is selling off after an IPO pop. One stock is surging 200% on an AI partnership. And the underlying dynamic in both cases is the same. The market is aggressively repricing assets based on their perceived position in the technology infrastructure stack of the next decade. SpaceX's satellite internet infrastructure, its launch dominance, its data relay capabilities. These are not irrelevant to the AI infrastructure narrative. They are potentially central to it. The actionable insight. Before labeling any price move as irrational, ask what infrastructure narrative the market is pricing in. Right now in 2026, that narrative has enormous momentum, and it is moving fast enough that today's sell-off and today's 200% surge can both be rational simultaneously. Here is where most intelligent investors make their worst mistakes. Not in analysis, but in the gap between analysis and execution. SpaceX is a genuinely extraordinary company by almost any reasonable measure. Its launch cadence, its reusability economics, its Starlink revenue trajectory, these are real competitive advantages, not narrative. And that is precisely why it's dangerous right now. When a company's story is this compelling, the human brain starts to conflate the quality of the business with the quality of the entry point. Those are categorically different things, and conflating them has cost investors real money across every major technology wave of the last 30 years. A structurally excellent company bought at the wrong price can underperform the index for years before the fundamentals catch up to what you paid. This is not financial advice. It is pattern recognition drawn from market history, and every individual situation is different. What disciplined investors do in a scenario like this is separate the question of conviction from the question of timing. You can have high conviction that SpaceX belongs in a long-term portfolio and simultaneously recognize that the 72 hours after a blockbuster IPO during an active sell-off is almost certainly not the optimal entry window. The distribution phase we discussed in Section 1 has to run its course. That takes time. It takes volume. And it typically ends not with a dramatic reversal, but with a quiet stabilization, few sessions where the stock stops making new lows on elevated volume and price begins to compress in a tighter range. That compression, when it appears, is the technical signature of supply exhaustion. Bloomberg is also reporting soaring profits in emerging markets, building a case for a raging bull market globally. If that thesis holds, it creates a rising tide environment where timing precision matters somewhat less. But it does not eliminate the logic of patience after a post-IPO distribution event. The actionable insight: define your entry criteria before you watch the price. Know what stabilization looks like to you, whether that is a specific volume pattern, a consolidation range, or a percentage retracement from the IPO high. Decide that in advance, not while the pre-market ticker is moving. Reactive decisions made against a compelling narrative are how retail investors consistently underperform institutional ones on exactly these high-profile names. We opened asking whether SpaceX's sell-off meant danger or opportunity. The honest answer: neither yet. It means a predictable distribution phase is running its course in one of the most watched names in market history. When that phase ends, the question becomes interesting again. Next, we're going to look at what the emerging markets profit surge means for global portfolio positioning in the second half of 2026, because that story is moving faster than most people realize. Subscribe so you do not miss it.